I'm Treggs. I'm head of risk at Flash Trade, but also about to be a CEO at Seedplex and part of the wonderful community of the Lucid Drakes. You can see mine there at the bottom right. I'm here to talk about sustainable revenue, distribution token design, or really, please don't release a token. So let's start out with the types of tokens that most users are able to buy on the market right now. We will have things like utility tokens. This is our beloved Solana. Things like Bat from the Brave browser, Link from the Oracle. We have governance tokens. These will be basically all the things that we loved during DeFi summer in 2020. This is Uni, this is your Maker, this is your Aave. And lastly, we have our also beloved meme coin tokens, your Doge, your Trump, your fart coins. And let's just kind of go over like what exactly you use these for. Utility tokens, by the name, they are used to pay for services provided. And a plus of this is that essentially, if a service is in demand, you should be able to, the token should show the demand to use for the service in demand for the token. So that's pretty nice. You do kind of get a price depreciation as long as people want to use the product. So something like Solana, right? Like if someone wants to use Solana and they want to kind of lock in their price of using Solana for a while, you buy a lot of Solana, and so people hold Solana. But the thing is that really this whole utility tokens, you don't necessarily have to use them. You can just use, we do have stable coins, and we can just use that to pay fees instead. Here's just typical money flow for utility tokens. Essentially, the users, they get their like real assets. I'm going to say USDC, and they get the utility token. And then they take that utility token, they go to the protocol, and they use it because they want to use the protocol. Fantastic. Then the protocol is like, all right, we have these utility tokens. We also want to award our team for working hard and like building all these years. So we're going to give the team our utility tokens. But the team are people. And unfortunately, I don't know the last time you tried to buy gas with Solana. I had a difficult time doing it. But I needed some US dollars or some other kind of stable currency in order to actually, use this money in the real world. So we've sort of created this layer in the middle that's not really needed. We can just go to the right here, and we can have the users give USDC to the protocol, and then the protocol can take that USDC and give it to the team. And now we just don't need to go with this whole abstraction layer. You want to use a protocol? Here's the fee. And that's it. Next up would be the governance tokens, and this is used to make strategic decisions about a protocol. The good positive is that you can have input on the decisions of the protocol. So if you are, a strong strategic mind, you own a lot of a token, you can kind of decide where the protocol is going to go, and ideally towards a more successful direction for that protocol. A negative, though, is that the scope of these decisions usually is made purposely quite limited. And then the way these tokens are kind of distributed is that there are a lot. The team has a lot, and then early investors have a ton. So the community, even though they are your main users and probably the people that love using your product the most and talk about it the most and care about it the most, they don't actually get to have a say in governance. And one of my favorite memes out there comes from Twitter. By Dejan Spartan, if you guys know him from crypto Twitter. And essentially, it's they're voting on what color Lambo should the founder buy. And the community is voting. First of all, it's a clear example of it's a decision that really does not matter, right? Like what color Lambo the founder has is not going to affect the future of the protocol. So it's kind of a show of governance, like, hey, we're deciding something, please give your opinion, but it's not actually going to affect the success of the protocol. This is because protocols don't want to give up control. They want to keep running their own game. They want to hold on to all the revenues that they make. They don't want to expand the team past the team that they already have. Things like this, right? But furthermore, not only is it a decision that doesn't really matter, but secondly, the founder has so many tokens that he can say, I like yellow, and so he'll vote yellow, and guess what? His Lambo is now going to be yellow, and we've done this whole governance thing for who knows why. Next up, we have our meme tokens. And honestly, these are probably, they're fun, pure speculation. They advertise, they promise nothing else. They are highly volatile. They're fun and sometimes even funny. But unfortunately, we've seen this a lot in the case of Solana. They can have highly predatory launch mechanics. And most do end up going to zero. And after all is said and done, no real value is created. But I guess we had a lot of fun. And the typical journey for a meme coin are charts that will seem all too familiar to all of us, where it's this huge spike up many, many multiples if you got in early, but almost inevitably, we end up at zero. It might take a week, it might take a month, it might take a couple of years. But again, these are not things that are trying to create real value. I do have to give a shout out to Bonk, however, who have managed to change this narrative, and I wish them the absolute best, where they've started out as a meme coin, but now are trying to do real things. So I suppose it is possible, but I can basically assure you 99.9% of meme coin traders are not looking for that exit into a real protocol. They're looking for that highly volatile, these huge price spikes that sometimes continue, and they're hoping to sell it for more than they bought it for, and that's it. So why are these the options available in the markets right now? And the answer is pretty simple. People like money. I like money. I don't blame anyone else for liking money. And the best way to get it, at least in our current environment, is to just sell something that resembles an investment in a protocol. But it actually isn't an investment. And just because we don't have options to get things that are function like actual investments in protocols, people will like, well, this is the next best thing, so I'll buy it. And so now founders will release a token, but it's not just founders' fault. It's also like early stage VC investors. They urge founders to release tokens so that they can liquidate into real assets and make this money that we all like. So the unfortunate conclusion that we must arrive after all this is that, like, well, what is the most useful thing that you can do with the token once you receive it, once it's out there, once you buy it? Oftentimes, the most useful thing to do with tokens is to sell them. And that's an issue, right? Like, this means that we're doing all this work, we're doing all this progress, and then we're just ending up at this conclusion of, well, great, we made this token, it's up and running, and all we can do with them really is to sell them, and hopefully at a higher price than I bought it at. There's some kind of approaches to this problem where, like, all right, let's kind of drive revenues in a certain direction. Let's try to, attach the success of a protocol to the token. And I think the main one that's being tried right now is the buyback and burn. For those that are unfamiliar, essentially what this does is take some percentage of protocol profits or revenue, depending on how that is balancing out for that protocol, and you go in the open market and you buy back the token, and then you typically burn those tokens. And the idea is here that, well, buying flows make the price go up, so that's good. Everyone likes that. And then burning them reduces the supply, which achieves scarcity. So scarcity also good, makes price go higher. It's a solid approach. I really don't mind it, except that it doesn't quite work. And we see a kind of case study here. Now, let's just kind of look into it. This is Metaplex. And on the left here, we see a tweet from Asari Crypto doing a report on, how they did the last quarter. And it was a record quarter for them. They generated more fees than they ever had before. They bought back more Metaplex than they ever had before. Quarter over quarter growth is up. Protocol fees generated is up by over twice as much as the previous quarter. So, you see these imagine you receive this news, and you're a Metaplex holder, and you're like, oh my God, finally, my vision came true, like Metaplex is gonna be the greatest thing ever. But then you look at what happened with the price, and it was down minus 55.5% in price that quarter. Not quite, rewarding the loyal token holders that are, believe in the Metaplex vision. So this buyback and burn, an issue that really lies is that it's buying back indiscriminately. It's buying back at whatever price the market is saying it, which means sometimes it's buying at very rich valuations by any kind of valuation methodologies. And then after those buys, the people that actually get to realize that are not your most loyal token holders that would never sell. It's actually the people that see this rich valuation and say, well, that seems a little rich to me, and I'm going to sell. And now all the loyal token holders got to experience none of the benefits of that revenue being generated. The mercenary capital that kind of saw it undervalued and now is able to sell it for higher got to realize all that revenue being towards them because it was all bought back and then burned. And so it doesn't quite make this attachment of success of the protocol follows success of the token price. And I will say there's a caveat here. This is a little bit cherry picked because during the same time, crypto itself didn't do so hot. And as we know, like there's correlations all over the place. But nevertheless, if you were after record metrics, if you were a Metaplex holder, your reward for that and for them doing so well was still minus 55.5% in price. Whereas if the same kind of, and I'm alluding a little bit to the future here, whereas the same revenue were distributed evenly among token holders, all right, this is okay. Record metrics, my token is valued less, but at least I got to experience some of those revenues being routed towards me after an amazing quarter. So a solution, as you can see on there, I'm head of risk and strategy at Flash Trade, and so I think one of our approach was pretty novel, and I want to kind of talk about it here. Not necessarily to shill it as a bag, but more like as an alternative that I hope other teams consider at least. So first and foremost, and this is probably the most controversial, is that during our TGE we gave 0 team tokens. The team got no tokens. And all of it was kind of given to our community, which were our NFTs. They were called Flash Beasts. They raised the initial liquidity pool and it's that base liquidity is what made the protocol possible. And so these are our early believers. And so from day one, when we were issuing these Flash Beasts, we told them, hey, if you want the token, if you want the future token, you look towards here. And we fulfilled on that promise to the absolute maximum we could, and gave the beasts an 80% of our token. So we aligned with the community as much as possible. And I think this is pretty key. Your community is one of your strongest things in crypto, so you want to get them on your side, whatever you have to do. We chose the maximum amount. Secondly, is futarchy-based economics governance, which I will get into later. And this third one is sustainable revenue distribution. And I've kind of highlighted here. And I'm saying, again, it's sustainable revenue distribution. And the first thing kind of pops to mind when I hear this from a growth company is a famous scene from Silicon Valley, which is an investor telling his company, no, absolutely not. Why are you going after revenue? We are a growth stage company. Everything should be put towards growth and reinvested into growth to become bigger and bigger and bigger and making yourself worth more. You don't like revenue at this stage. What? It should be if you are growing fast, you should be spending every resource, including every single dollar, towards growing fast, and not necessarily. And if that means charging your users less in the meantime and going after less revenue, that's probably likely the higher EV play in the long run. I'll take some inspiration from why don't companies start revenue distribution during their growth stages? And it comes to pretty simple things. This is how it works in the traditional finance world, but it's cash flow management. Early stage companies, they don't have that much money. And the company is in a unique position where they are one of the only ones that can invest in the growth of the company. External investors, they don't own enough of the company to be motivated to put a lot of dollars into the growth of that company. So the only opportunity available to invest into the growth of a company is from the company itself. And therefore, every single dollar should be used to further growth, to capture more users, to develop new products, to do more research and development. What's more is that investors actually expect this when they invest in growth companies. When you invest in Uber, in the Series A or Series B, you're not expecting them to start issuing you dividends anytime soon. As a matter of fact, it's very likely that at that investment point, they were losing money every year, so they don't have money to give you anyways, and they needed more money to continue this hyper growth cycle that they were chasing. But that's okay. Investors expect this, and it's this kind of expectation that I would like to see more in crypto. That we are early, we are very early, and so we should really not be looking to grab money and give it to our holders. We should be trying to capture as much market share as we can. We should try to capture as many users as we can, because that will actually result in better results in the long run. Next is just, further emphasizing you're financing growth. And if you give out money, that means that's money that you couldn't use for growth. And again, this is crucial for maximum trajectory towards being a huge company. To further emphasize the point of crypto is a very fast growing industry and one that increases the number of users by a massive amount year after year. And not only users, but also increases in revenue year after year. So why are we so focused on cashing in now? We're just getting started. This brings me to the second point. It's like, okay, fine. You're telling me that I don't want to get, as a company should not give me revenue, but at some point they should, right? Like if there's someone's making a lot of money and I own a percentage of them, I should realize some of that money that they're making. And so, like, when should they start distributing revenue? And it's like when things start getting consistent. And so when there's profitability and cash flow, essentially, right? When there's lots of strong profits that are consistent, we know where they're coming from. We can say with reasonable certainty that, hey, 6 months from now, this is about how much we're going to be making. And this allows us to say, all right, we can afford, like, all our growth opportunities that we have are going to cost us this much. And then we have all this extra cash. All that extra cash now can finally go back to token holders. The good news is that this is now at a mature stage. This is after all that hyper growth was done. This is after they've acquired absolutely every user that they can possibly acquire at a reasonable cost of acquisition. This is a very big company. And now here's where, like, the token holders, their expectations is like, yeah, here is now, like, that you've acquired, well, you've become this huge protocol, you have all the users, it's going to be very difficult for you to get more. Okay, now it makes sense to start distributing revenue. To give us some examples from the traditional world, companies that do this are banks, huge ones. They're utility companies. Like, utility company is not going to find another continent anytime soon to expand into. What they got is what they got. And so utility companies distribute dividends. So what should we use to decide when it's finally time? Like, we're in crypto. It's a brand new industry. We don't know how big it's going to be going. We don't even know how to really value the founders, the person, etc. Like, we don't really know when to know, like, okay, when is big enough to start distributing revenue? And here's where our second point comes, that is involved in Flash Trade, and it's futarchy-based economics governance. And that means essentially anything that that involves the economics of a token, whether that be inflation or revenue distribution, will be put up against to a futarchy decision. Now, I know futarchy hasn't taken over the world yet, so I'll give a quick explanation of, well, what the hell is futarchy. And that is essentially what it boils down to is decisions are made according to what the market deems most valuable. So we have an example graphic up here. And you can see here that the decision here is, all right, I'm going to allocate 40% of the treasury to staking in this DeFi protocol. And what happens then is that two markets are created. And they're both kind of hypothetical markets. And it asks the market, well, what would the treasury value be if we don't do this? And that's option B. But what would the treasury value be if it is implemented, this kind of proposal? And it's a decision market, so you don't get to just, like, vote with a token like, oh, I think A is better or B is better. You actually have to say and bid at a price of, hey, no, I think the value of the treasury, if A is implemented, will be this value, and I will bid according to that value. And same for the market B. That you have to actually either sell into that condition or you have to buy into that condition. And now the way a protocol makes a decision is, well, which one of these decisions ended up making the token price go higher? Which one predicts that the token price goes higher? And this is essentially futarchy. And I believe that this is basically to make the decision of long-term growth, like hyper growth versus just a more stable and, like, time to release distribution of revenue. Futarchy works very well for this because it's literally taking that input from the market, and the market is telling you, hey, it's time to distribute revenue, or it's not time, continue to grow. So my main point, after all is said and done, is that we are still so early in crypto. We're just starting out. And what's more is that the protocols you guys are building or you guys are using are even earlier. Your protocols are like 1-2 years old, and already, like, people are clamoring at the doors if you're a token holder to start distributing revenue. I think that's premature. I think the potential. We saw the trends, right? They continue to go up, and they're going up in nearly exponential fashion. But when it is time to make the decision, I do believe futarchy is one of the best systems to make that decision of, all right, we've grown enough. It's time to kind of reap the benefits of all our work. So, okay, fine. It's time to distribute revenue. How do I do it? And I would say sustainably. It's so important, right? Like, especially in a cyclical market like crypto is, it's very important to be aware of what is the opportunity available to investors at all times. In traditional finance, this is basically you measure what you expect to make on an investment, and you always measure it against the risk-free yield. The risk-free yield in traditional finance is U.S. Treasuries, but as we know, if you're bringing USDC and you're getting US Treasury yield, you're not that happy. Oftentimes, the risk-free rate in crypto is quite high, especially in bull markets. We've seen Camino, USDC borrow rates go up to like 25%, and lending was earning like 17% pretty often. So every investment in crypto has to outperform that from an investor's perspective, because if the risk-free is 17%, why would I put a lot of money at risk to maybe make 25 or 30? So when you want to distribute revenue, you have to make it dependent on this risk-free rate. And the way you do that is by making the amount of revenue that you share with your holders be directly related to this. And I've kind of just outlined a very quick methodology here. And essentially what you do is like all this revenue that's generated, you put it into this treasury. You put it into this huge treasury, and that treasury keeps getting bigger and bigger over time as you add more revenue to it. From this treasury, team expenses are being made, but we're assuming profitability here. I know sometimes a rare concept in crypto, but we're assuming, a real business. The money gets put into this treasury, and that treasury is put into DeFi yield protocols. Ideally, some of the safest ones, because this is where the quote-unquote risk-free rate is. And so that's where we're going to put our money, where we deem it to be quote-unquote risk-free. And from those DeFi yield protocols, you're going to be gaining yield on all that money in the treasury. And it's finally on that money that's earned from that treasury yield, and that's what you give to token holders. And what this mechanism does is it makes the treasury go bigger if your protocol achieves more success. If the treasury is bigger, it's going to earn more yield. And then, because you're using the DeFi risk-free rate in order to reward token holders, it makes holding your token a very attractive proposition regardless of the yield environment. So when things are running hot, Camino's giving you 20% for just parking your USDC there, the rewards for holding a token have to match up to that level. And therefore, the amount you give back to your token holders should also go up. Ideally, your treasury is also growing from the revenues you're making, but at the end, then the opposite is true. During a bear market, if the yields are down, you're no longer, sending out a ton of money into all these people that, would probably accept less and still hold your token. So you directly relate, how attractive it is to hold your token to this DeFi risk-free rate, and that makes your token attractive to hold in any environment. I know you might be asking, well, what is this guy talking about? Did he just make all this up? Where is this from? And where all this comes from, these ideas, is traditional finance, where there's tons of early stage investing, there's tons of mature companies, there's a whole stock market of companies that are in the midpoint, and this is the approach of how all equity is structured for seed, Series A's, etc. And the big thing is that they get that investors in these companies have protections, they have entitlements to future revenues, and that's pretty key. Another thing is that growth companies can be growth companies. These huge companies that you see on the right here, Airbnb, Uber, Stripe, these are all success stories. And but they were all unprofitable for over 10 years. They did not make money. But the result of all that is that they're all worth over $50 billion. And to this day are still sharing $0 of revenue to their shareholders. And that's okay, because eventually, when the time comes, when they finally have taken over the world, how many of us took an Uber or staying in an Airbnb? When all of us are doing that, now it'll be time to start sharing revenue. They have reached the capacity of their growth. Here are some of the security holder entitlements and protections that people have when they buy these securities, and it comes down to a lot of the things that we want when we buy crypto tokens. We want voting rights. We want this real input on key corporate decisions. We want to be able to have dividends or revenue sharing at some point, and we want that to be on paper, on the contract of when is that going to happen and what are the conditions that it happens. We want the case that if the company disappears tomorrow, that I'm going to get my fair share of the company if that company has assets. We have seen multiple protocols kind of raise a ton of money in Solana, not do much for 3 years, shut down, and then all that money raised kind of just disappears or ends up with a very unfair allocation of that money when it comes to token holders and equity holders. And lastly, preemptive rights is pretty important in the case that there is more raising opportunities, because with equities you can essentially mint infinite tokens. You want to be able to make sure that you don't get diluted to zero, and usually a way to do this is making sure that any shareholder always has the ability to keep their fair share of the company should they be willing to invest at the same terms that the new round is coming in. So security holders, they have various rights, they have various protections, and most importantly, they have a fair share of the company's future revenues and assets. What I really want to do is bring these holder entitlements and protections on chain. Now, whether we do that through smart contracts, through clever mechanism design, fantastic, or whether we do it by bringing securities fully on chain and bringing those legal investor protections on chain, whatever. Let's try to do as much as possible to make sure that there are tokens out there worth buying. Thanks so much, guys. I'm happy to answer any questions.
So you would be willing to incorporate in certain jurisdictions then, right? To bring those protections on chain, would you then have to do like choose a jurisdiction and then incorporate over there, right?
Sure. If you're going the pure security token, like if you are in a jurisdiction where you are afraid to launch an unregistered security, yeah, you do have to incorporate and you have to do things properly. You have to follow the regulations when it comes to like people you can raise from. You have to do the right things, the way things have been done. But the thing about on-chain is that things that used to have a lot of friction, money transfers, borrow land, etc., like we've experienced it. So if you go to the bank and you ask $100,000, they're going to ask you for infinite records. However, if you go to Aave or you go to Camino and you deposit your Solana, you get a $100,000 loan in less than a second. So yeah, you do things the right way, but I believe crypto can provide a lot of less friction in using this kind of equity once it's actually established on chain.
And has Flash Trade done it? Yeah.
Flash Trade has not done it. Flash Trade has taken the opposite way of we want to do it through mechanism design and through futarchy governance, and we want to go that route. However, there are other projects, one that I'll be leading, that is trying to do exactly that.
Cool. Thank you.
Hi, Treggs.
Hello.
Alicia from Streamflow here. Great presentation. And I have a follow-up question on this, which is, everything that you spoke about, the token accruing value is makes it a security, essentially.
Yes.
How are you avoiding this or, making it not a security with Flash Trade tokens? Because there are legal limitations and legal concerns, and I understand the on-chain world, but there is what they call a real world
Yeah.
as well. And you don't want a token be classified as a security in certain jurisdictions and then having the problems because of that.
No, that's a very real concern. So the question essentially is, well, like if you do all these things, are you not just making a security and exposing yourself to scrutiny from regulatory agencies around the world? The answer is yes. The closer you get to being a security, the more you attract attention. However, there's a number of things, crypto as a whole, we work in the gray areas. How do we know that the Ethereum in our wallet was never in a North Korean wallet and therefore like our wallet should also be sanctioned? How do we know that an exchange never touched any kind of dirty money and therefore like our wallet should be sanctioned? So there's always a gray area. And for the most part, we just do our best. And you don't ever want to be the nail that's sticking out the largest, right? You don't want to do egregious fraud. You don't want to do egregious, unregulated security selling. So you design mechanisms. You decentralize the governance as much as possible. So like futarchy does a lot of that. And so you kind of make it as much as possible not your decision and not dependent on your efforts for the success of the token. And you stay in this gray area rather than this red area where you for sure are security and you will get regulatory prosecution at some point. I know we're running out of time. Maybe that might be it for questions or. All right. Well, thanks everyone for listening to my spiel up here. And yeah, feel free to talk with me afterwards. Happy to talk about Flash Trade and NKNO.